Hi, this is David Duty in Boquete, Panama, and we're going to look at video number 3, Options or a Decaying Asset. And as you can see, I've done a little bit of work on the lean hogs up for October 2006 contract. And I want to show you that we're set up here to buy a 64 call. Right? The value of that call is $1,240. Now we're going to play it forward a little bit, and we'll get filled on this option. Now, let's figure our break-even at expiration. Obviously, the value of that option can change, but let's pull this down to 64. It's a 64 call. And that option would have to go up $1,240 plus commission. So it's, say it's got to come up to about here at expiration. All right. So at option expiration, the price has to be here or higher for us to make money on that option at expiration. Now, obviously, during the time frame from now until that option expires, that option could increase in value drastically if the market rallied, and decrease in value if the market went down. But at expiration, the market would have to be at that point that I just showed you here for it to break even. All right? Anything above that would be a profit. Now, these two lines here that you'll see, that's where the market's actually going to go. It's going to go up, it's going to go down, and at some point it's going to come back up or down to here, and then come back up or down to here. And the reason I wanted to show you this is because I want to show you what happens to time value of these options. Now, remember, we paid $1,240 for it. Let's just make a note of that. Paid $1,240. All right, let's play it forward a little bit. Obviously, we were filled. The market's going against us, so the value of that option is going down. Now it's only worth $1,010. All right, now it's worth $1,200. Came back up a little bit. $1,100, $1,100, $1,120. As you can see now, it's only worth $620. Now it's down to $500. So, we've lost $500 to $1,200. We've lost a little over $700 on that option so far. But as you know, since I've already shown you the circles over here, the market's going to come back up, and it's going to hit this area. All right, here. Now, the value of that option is $830, and it's at the same price that we entered the market earlier. Or in other words, the market currently is trading at about the same price it was the day that we entered that market. But that option now is only worth $830. We paid $1,240 for it, so we've lost $410 plus commissions on that option so far. In other words, you could actually buy that same option today, where the market is here. All right, the 64 would be $830. So it's a lot less money here than it was back here. And the reason that it's worth less is because of the time decay from here to here. In other words, it's actually 35 trading days further out than what it was when we purchased it. So that time has eaten up some of the value of that option. Right? Let's play it forward. Now the market is going in our favor. And it's up to, it came back down. Right here, that option is now worth $1,410. Right, but we paid $1,240 for it, so it's gone up a little less than $200 for us. Right, now let's see how much in the money that option is. And as you can see, that option is $670 in the money right now, and it's worth $1,400. All right. So the difference in those prices is the remaining time value that you're paying for. All right. Here, that option is worth $1,700, and you can tell that it's we paid $1,200. It's worth $1,700, so we've made a profit of $500. But how much deep, or it's deep in the money, or getting deep in the money, and we purchased it here, so we've got $1,200 worth of intrinsic value on an option that's worth $1,700. Now, the difference between the $1,200 of intrinsic value and that $1,700, there's two reasons for that. Obviously, the first one or one of them, is the time value that's remaining on the option, and look at the market. It's just taking off like a rocket, causing volatility, which we're going to look at a little bit later, meaning that it adds value, or the cost of that option is going to go up because of volatility as well. Right? So let's go a little bit further. Right? And you can see it's gone up $600 in value, approximately $540 in value. But look how deep in the money it is, or above the strike price of $1,600. Right? But the value of that option has only gone up $600. The time value is just eating away at us here. All right, now the market starts to come back down. It's worth about the same thing that we purchased that option for. Back here it's for $1,260. We paid $1,240 for it, and it's $1,000 above the strike price. So time value has really hurt us here. All right, now you can see here that the market is currently trading at about the same place that it was when we entered that market. But this option is only worth $370. Right? It has no real market or intrinsic value to it. So that $370 is basically just for the remaining time value of that option. So just keep in mind that just because the option at expiration is above, or even during the trade, not necessarily at expiration, but during the trade and especially at expiration, just because the market is above where you purchased the call or sold the put, and the market is below it, it does not mean that you're going to make money on that option. Here you're in the hole, $630 in the hole, or the option is worth $630. You paid $1,200 for it, so you're about $600 negative or upside down if you liquidated that option right now. You'd have lost $600, even though that the market is above your strike price by $550. You've still lost money on that trade. So here the option is worth $410, and the reason it's worth something at all is because it has some intrinsic value to it. It has $410 worth of intrinsic value. That's why it's worth $410, because the option is getting ready to expire. So if you were to convert that option to a futures contract or liquidate that option, you would actually get about $410 because that's how much deep in the money that it is. Let's look at another chart. All right, let's look at sugar. Okay. Obviously, sugar's been on a roller coaster coming down. But let's say that we purchased a put back down in here. Right? Market is close to this area now. Now, remember, the put's going to be expensive right now. You hear the siren in the back. It's almost 12 o'clock, and that's our little town siren going off, if you can hear that in the back, to let everybody know that it's lunchtime. So the town takes off for lunch. Right? Let's say that we bought a put that's a little bit in the money, a $12.50 put for $1,280. Right? So just remember, we're paying $1,280 for this put. Right? Now, a lot of that obviously is for time value, or most of that is for time value, because it's not enough in the money to matter that much. But we've got a lot of time left on this option, and we're going to pay for that time. Let's play the chart forward a little bit, and you'll see that we're filled. Now, the market is back down to where it was, and it's worth $11.60, about the same thing, not much different from where we paid for it. Now it's worth $8.36. Right? It's going against us. It's going back up. So it's worth about where we got into the market. Not much difference. Now we're at the end of the contract, right? And the value of that option is worth $1,489 right now, right? We paid $12, so or $12.60 or whatever it was. So we're up a couple of $100 on that trade. But how deep in the money are we? Right? right now it has $700 worth of intrinsic value. Right? So the difference between the $700 worth of intrinsic value and the $1,489, the difference there is time value and volatility. And we'll talk about volatility a little bit later. Right now I just want to show you some time value. So just keep in mind that every day that goes by, that option is going to lose some time value. It may increase in price if the market is going in your favor, but it's still going to lose some of that time value. Think of it as like a block of ice, and every day that it goes by, that ice melts a little bit. Right? So those two examples were just to show you, obviously, that we have some loss in time value from an option. Right? See you on the next